This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. Let's even break that down a little bit before we dive in further. But commercial real estate broker, we hear that terminology in our industry all the time. Give us a little more detail about what you do, right? What does a commercial real estate broker do? Give us some of the day in, day out types of things, especially as an operator or maybe some newer operators that are listening. What do they need to know about what you do and why?
Yeah, so I would break a broker down into kind of two separate paths. You've got a generalist and a specialist. So typically in smaller markets, it's hard to be a specialist, meaning a specialist focuses on one product type. Whereas a generalist will do all of commercial real estate. They might do just sales of any product type or leasing or both. And the product types could be multifamily, retail, office, industrial, self-storage, land that's zoned for commercial development. And there's a few others as well. But I'm a specialist. So on the brokerage side, I focus solely on multifamily investment sales. And as I kind of shared, we have a 10-person team. So we're geographically focused. Every person on our team has a geographic focus in addition to being a multifamily specialist. So if you came to me and said, "Hey, Doug, I've got this great shopping center and I'd love for you to value it for me and sell it for me," I'd say, "Whitney, I appreciate it, but I'm going to introduce you to somebody else who specializes in that. That's not my forte. That's not what I do. So I'm not going to be the best execution for you. But if you have a multifamily deal that falls within the geography that my team or another team within Graysteel is covering, absolutely, we can help you." So we are out there touching base with all the owners in the geography. So for myself, I'm very much have been for 11 plus years, Dallas County focus. So most of the owners in Dallas County, so the eastern portion of the DFW Metroplex, at some point or another, I've probably, touched with a phone call or many emails, right? Because we're a marketing machine at the end of the day, active on social media as well. But I want to get in front of the owners, understand who they are, why they purchased their assets, what their business plan was when they bought it, and how I can help them achieve their goals, right? I want to be an advisor for them and a partner because I earn my money on the back end. So we have the same license as somebody selling a house. We just have a real estate license, but we're referred to as brokers as opposed to agents or a realtor. A realtor, a real estate agent is typically what you would refer to somebody selling your home, which I have a real estate agent who works at Compass, and I hire him to sell my house. Even though I'm licensed to do it, that's not where my expertise is. So I hire the professional to do that when the time comes. But if I own or I'm representing somebody with a multifamily property, of course, that's where we come in and we charge a commission on the back end. But we're helping advise for months or years up until that sale. And that's kind of where we build the relationship and the trust to where, hopefully when the time comes that they're going to sell that asset, they hire our team.
Right. No, that makes complete sense. I appreciate you breaking it down like that for the listener to know as well, a generalist versus specialist. And I think it goes without saying as far as why we would want a specialist, right? In so many ways we could talk about why that's so helpful. But when would we want a generalist?
I think generalist, I've got a very good friend in Morgantown, West Virginia, and he, of course, would refer to himself as a generalist, but he's a specialist in that market. So I think if you're in a smaller market, it makes sense to work with a generalist because they're going to know the ins and outs of what's going on, whereas someone like myself might not. But in my mind, it really depends on the product type because a multifamily specialist, if it's a multifamily deal, was probably going to be better served because we have a lot of access to tools, CoStar, Yardi Matrix, Trep, Reonomy, just to name a few, where we can kind of get that market data, even if we're not physically located there. I think leasing, you can work with a generalist as well. So I think really learning an area.
A ton of sense. And I think it'd be very market specific, but like your 5-hour radius that you're talking about, There's so much commercial real estate, right, being traded. I could see that being no doubt a place to, man, have that specialist. But I thought it was a great example. Morgantown, West Virginia, there's not as much multifamily trading as there is
Right.
in Dallas, Fort Worth, right? And so
Sure.
I can see even why that broker would need to be a generalist to some degree, right? To even make a living, maybe to have the transaction volume.
100%.
But even be able to help more clients in a smaller, right? Versus in your market, well, there's multifamily clients just coming out of the trees, growing
Yeah.
off the trees.
Yeah.
Let's talk a little bit about, and I'd love your take on like reasons to invest in commercial real estate today. And while there are trillions of dollars, right, we all know sitting on the sidelines today, waiting, right, for something to invest, right? I would just love your thoughts on reasons to invest in commercial real estate, maybe generally for some of our newer listeners, but even what you're seeing in today's market and why still today is a good day, if you believe so, to invest in commercial real estate.
Yeah, absolutely. So there's a number of reasons to invest, but there's a lot of tax advantages, kind of number one. So obviously you can go out today with the treasuries and get anywhere from a 3.5 to 4.5% risk-free yield, right? Because it's government backed, but there's no upside. Your yield is your yield, and you're paying ordinary income tax on that margin or income that you're collecting on that. Whereas on the real estate side, without getting too technical and going into the weeds too much, there are tax laws and benefits such as bonus depreciation, which is going on a 5-year sunset right now. I think it's 80% this year that you can bonus depreciate anything that's on a 15-year schedule or shorter. So what that means is even though your property may be generating income and you're getting distributions, if you're an investor or the owner, you're probably not paying taxes on that income in the early years because you have enough depreciation to offset that income. So there's a lot of, so your 5% or 7% that you're making on your investment is tax free or tax deferred, I should say. Nothing's ever tax free. You're deferring the taxes, and eventually, unless you die, and then there's tax laws that kind of get taken into account there, but you're just deferring those tax payments through taking depreciation and other things. So that's one reason. So I think if you're able to achieve a yield at or ideally above, what you can get risk free, it makes sense because you're not paying taxes on that income in the early years. You also get the benefit of appreciation, whether that's organic appreciation, meaning just market growth, because you're in an area where rents are growing on a consistent basis. Like DFW, we have 140,000 people a year moving to the Metroplex. So nearly, 400 people a day. There's not enough housing, even with the amount of units that we're developing and have developed over the last 10 plus years, between 20 and 25,000 units a year on average. It's a lot of inventory, but there's a lot of people moving here. And so there's still a housing shortage, not only here, but all across the country. So if you have that rent growth, then you're going to have appreciation on the asset, assuming all else equal, right? If your expenses don't exceed your income growth. So you get that appreciation, you get the tax benefits, and you have a tangible asset. For me, early on in my career, I invested in stocks, and I still have a 401k and kind of do the diligent retirement things, which I joke with my financial advisor, who's been one of my best friends since I was 3 years old. Very boring investing. And I really don't know what I'm investing in. I mean, I understand profits to earnings ratio and things like that, but I really don't know what I'm looking for. So I rely on them to kind of make good investments for me, but I don't get the tax advantages when I invest in stocks and equities. And I don't normally get the appreciation. It's out of your control what the stock's going to do. So I invested in some Amazon stock a few years ago thinking, how could Amazon ever go down? Well, it did, right? So I don't think it's going out of business ever, but certainly there's just market influences that are outside of everyone's control that can impact the stock price and markets. And there's a lot of volatility everywhere right now, including in the real estate market. And there's a lot of different benchmarks that you'll hear people talk about that different lenders will go off of, right? You've got the federal prime rate, which Jerome Powell and his team have pushed. I've lost count, but I think it's been about a dozen times since last March in the last 15 months. And hopefully they're going to stop soon because they push that rate up so high, more than doubled in the last year, that it's very hard for construction loans and kind of short-term bank loans to get done today at these higher interest rates. So it's really slowed things down on the transaction side of things. You've also got treasuries. So if you're going to put fixed rate debt on, a lot of times with Fannie Mae and Freddie Mac, which are multifamily lenders, they will go off the 5, 7, or 10-year treasury rate benchmark, and then they'll put a spread on top of that. So your treasury rate plus your investor spread is going to be your interest rate. So tracking those things, and there's been a lot of volatility in the 10-year treasury, right? If you're looking at 10-year fixed rate money, I was invested in a deal that we put 10-year fixed rate debt on early in 2022. And I want to say the 10-year was at about 175, and now it's up in the 370 range. So it's gone up almost 2% since the beginning of last year. Pretty significant, more than doubled on that benchmark. So,
yeah, very significant. Are there other benchmarks that you could elaborate on, or at least share at the moment, that we should be watching, or that you are watching today, or that lenders are watching?
Yeah, so SOFR is another big one. So if you're talking about floating rate debt, and I should know the acronym, I think it's overnight fund rate, but it replaced LIBOR, which was kind of the floating rate benchmark that many of the banks and other lenders bridge loans would go off of before. So right now, I think it's a little bit above 5%. And so normally there'll be a spread on top of that, 300 basis points or 3%. So you'd be looking at an 8% rate, kind of on the lower end for a bridge loan today, whereas SOFR a little over a year ago was kind of between 0 and 0.5%. So you would just be paying the spread, or a 3 to 3.5% interest rate in early 2022, before the capital markets started to implode and just increase, which made the market slow down and values start to drop.
How do you feel about investing or buying multifamily properties today? I mean, in the current economic climate?
Yeah, so I kind of look at it two different ways, right? What I'm more, as an investor, I'm focused on the cash flows, because the market appreciation that we were seeing before it just wasn't sustainable, right? Debt was very cheap, not free. A lot of people would say, "Oh, it was free money." It wasn't free, but it was very cheap, right? If you're borrowing money at 3%, historically speaking, you go back 50 years, and I don't think there was a time period where money was less expensive. Now, that short-term debt's kind of up in the 7.5 to 8.5% range. It's getting expensive, but then you still have fixed Fannie and Freddie debt in the mid 5% range. So you've got a pretty big delta between short-term and long-term debt. But if you're able to buy something at a cap rate that's what I would call cash neutral, at least during the interest only period, that feels pretty good. And that's where we're seeing some deals trade. It might be slightly negative, meaning the cap rate's a little bit lower than what the interest rate you're borrowing at is. But if you're getting lower leverage, you're getting a lot of interest only. So for example, if you do a 10-year loan, it's pretty common right now at, say, 60 or 65 loan to value leverage, you're getting 5 years of interest only payments. So assuming you're able to go in and do some things to reduce some expenses, or do a value add and increase rents or other income, then you can kind of get back into that positive leverage territory to where your cash flow exceeds your interest rate. I'm looking at that, and I'm very focused on what my hold period is. And if I do have principal payments kick in, then there's an equation or a phrase called a loan constant that I don't hear a whole lot of people talk about, but that's really what your cost of capital is. So I want to make sure that my asset is ideally getting to a point where it's reaching that loan constant on a return on cost basis once the principal kicks in.
What do you see in terms of the next 6, 8, 10 months in multifamily specifically?
Yeah, there were a lot of debt funds, which is a bridge lender. And there were a lot of them that were just coming out of the woodwork after COVID hit, and there was a lot of money out there, and that money wanted to be invested and put to work. and they were going into deals highly leveraged. So I would say second part of 2020, there were some agency loans still getting done, but really in 2021 and the early part of 2022, most of the deals that we were selling had debt funds being placed as the debt because they would go higher in the capital stack, meaning higher loan to value or loan to costs than Fannie Mae or Freddie Mac would go because they were being debt constrained. So a lot of groups would put this high leverage debt on. And if they bought a rate cap, meaning your interest rate could not exceed a certain level, then they're kind of sheltered and protected for that period of time. A lot of times those rate caps are for 2 or 3 years because these debt fund or short-term bridge loans were typically 3-year terms that are floating rate debt based off that benchmark and a spread on top, plus 2 1-year extension options. But given where the markets have shifted, they're probably not going to be eligible for those extension options. So they're going to have to do something by the end of year 3. And if they didn't buy rate caps, they might be paying 8% interest right now when originally they were penciling 3 or 4% interest. So their debt service has more than doubled in some cases. So I think we're going to see a lot of those deals come back to market because they're either going to have to do cash injections, raising more capital to get a new loan because they're this with where interest rates are today, they're not going to pencil to replace the loan balance in a lot of cases that they originally took out, or they're going to sell those assets or be forced to sell because they can't raise the capital. So we're going to see more of that because we're going to see a lot of those maturities from 2021 start coming due in the next 6 to 12 months.
Yeah. What do you think is going to be I was just thinking about investors are fearful right now, right? And I think it's obvious because there's like more money on the sidelines right now than ever.
Right, right.
Just like waiting. In your position, what do you see as like the way operators, because I know this is a big question I get all the time as well. We wonder if everybody does, like positioning an opportunity to investors in a way that to really showcase, hey, this is a good time to buy something. Let's say, let's say over the next 6 months, if it's a good deal. I know you talked about, I loved your focus on cash flow type thinking because we want cash flow. And how could you help maybe the operators, you work with many as well, to think through how they just communicate the story of the deal in a way that's like, no, this is a good time, or even communicating the story of the market, right? Or the economic cycle that, hey, this is a good time for investors to invest.
Yeah. So once again, it kind of, to me, it goes back down to those cash flows. So as long as you're not running the risk of getting into negative territory where you can't cover your debt service, and depending on what your goals are as far as IRR returns or just coupon mailbox money, it really all depends. And we've been seeing a flight to quality. So 80% of the people I talk to will say, I want something that's 1980s vintage or newer. Well, great, right? I understand there's less issues with plumbing, electrical, mechanical, electrical, plumbing kind of systems. But for that reason, there's also a lot of owners of that product that just aren't trading it right now. So we're seeing a lot of the older vintage deals trade hands. So to me, it kind of comes down to a few different things. Location is obviously very key, right? In my mind, I want to be in a market that is going to continue to grow because I'm going to have that rent growth and that organic appreciation over time, even if the next year or two might be a little bit tricky as far as figuring out what your exit value is going to be. I'm looking at the cash flows, and then I really want to understand who my operator is, right? Assuming I'm in a limited partner position. So who is my GP, my general partner, and who is their team? What's their track record? And then who's going to be managing the asset if they're not vertically integrated, right? Where they have management in-house. So I want to go meet those folks. When I go make an investment at this point in my career, I'm making pretty heavy investments, and I've been fortunate to meet a lot of operators and see a lot of people do really good things and make mistakes as well. So you want to learn from both, but I would say meet your general partner and their team as well as the management team and go visit a property, drive through, and if you can, tour the asset and understand how they're going to run it for you. Because I would say if you're looking at something short term right now, it's going to be a little bit tricky. But if you can kind of look at that 5-year horizon or more, real estate, just like everything, it goes through cycles, and the values are going to go up over time, right? If you're in the right location, you have the right operator.
Yeah. Yeah. No, many great points. And I know anybody listening right now is just wanting to know, how bad do you expect it to get? Do you or worse, or like over the next few months or a year? Just your thoughts on when we should see it come back. And
Yeah.
why?
Yeah. I mean, it's very, in my mind, very market specific.
Sure.
There will be distress in my mind in every market because some people just got too highly leveraged and in over their skis. But other markets that have challenges on the coast, for example, insurance has been crazy. So we're seeing properties down in Houston and Louisiana and some parts of Florida where insurance has doubled or tripled, and the rents aren't growing at the same rate, right? So not only maybe has their interest rate gone up, but all their expenses are going up at the same time. And real estate taxes in Texas in particular, and other markets as well, can be very tricky because Texas is a non-disclosure state. So depending on the county in Texas, we've seen anywhere from 30 to 50% increases from last year on their proposed taxes. And then there's a process where normally an owner will hire their tax consultant to go in and protest those taxes and fight with the appraisal review board and see if they can come to an agreement. And if they don't, they go to litigation. And all of that takes time. So we're kind of in this gray period right now where they're still figuring out what the 2023 values are. So it's kind of tricky. But I think we'll see the second half of this year and probably the first half of next year, a lot of that debt fund money get flushed out. So we're going to see distress in a number of markets, like I said, because you can't refinance in most cases those same loan amounts, and certainly not at the same interest rates as they were going in. But as far as values, cap rates have expanded, I'd say 75 to 100 basis points from the low. We were seeing Class A deals trade in the mid threes, so call it a 3.5 cap in DFW at the peak. So early last year, late 2021. And now those same deals are probably trading at a 4.25 or 4.5 cap. And then the Bs are going to be probably 50 basis points wide of that. So 475 to 5. And then the Cs are probably going to be 5.25 to 5.5 in DFW. So that 75 basis point increase has been about all else equal, right? Assuming your NOI has stayed relatively flat. Now we still have seen some rent growth, but also some expense growth, about a 15 to 20% drop on most values from where they peaked. And I really don't anticipate seeing it drop that much more because of where fixed rate debt has stabilized. Even though the treasuries are bouncing up and down, unless we get back above 4% on the 10-year treasury, which, like I said, we're in like the 3.7% range, but we've been down in the last 30 days as low as 3.4 and as high as 3.8. You're going to be able to get fixed rate debt in the mid fives. So staying in those kind of low to mid 5 cap range for Class C and maybe a little bit lower for B, to me, makes sense. And then looking at the treasuries, right? So if you're looking at a risk-free yield by just buying treasury bonds or buying real estate, I still see Class A deals being able to trade kind of in a 4.5 cap range, because that's going to be a little bit wider, and you also get the tax advantages than just buying a T-bill. So what I'm waiting to see is the institutions really start to reinvest, because they've been sitting on the sidelines for 9 to 12 months. Not many of them have made many purchases or trades, but we're starting to see Blackstone force some sales with some of their partners because they're getting a lot of redemption requests and having to return billions of dollars in the B REIT. But I'm curious to see when the other institutions have sat on the sidelines too much or too long and start to reinvest and the money start flowing back in.
How will you know that?
Tracking sales. And a lot of these are publicly traded REITs. So you're going to kind of see assuming you're subscribed to different publications. I read The Morning Brew, CRE Daily, Is Now, CoStar. a lot of these publications will announce major trades that have happened. And you'll notice the number of articles over the last year have shrunk quite a bit, where I can get through a quick scan over something in 30 seconds that might have taken me a minute or more before, just kind of looking at the titles of the different articles. So I think once you start seeing those articles expand a bit more, and you read some bigger sales north of $100 million, whether that be single assets or portfolio trades, you're starting to see institutional money flood back into the market.
Yeah, that's helpful. I always love hearing where people are getting their information, right? I get that question often from listeners as well. It's like, man, there's so much you could try to read, right? Or digest. How do we know where to focus, right? Our energies to get the best information. So I just love hearing, where, man, some of the people like yourself in the business who are very deep in the business, right? This is your business, man. What are you reading and trusting? So that's very helpful. Doug, I want the listeners to know, I'm going to ask Doug our normal ending questions, but in tomorrow's show. But is there anything else, Doug, before we have to move to the next segment, that you would leave just a listener with right now who is, let's say, a passive investor or an operator that, man, they need to be thinking about over the next 6-12 months as they're all wondering that maybe I didn't think to ask you?
Yeah, I mean, the only things I would say is, and we're seeing a lot of people very focused on operations. So once again, just sitting down and going over budgets, and not to just do budgets to do budgets, right? But really come up with numbers and projections that you feel are achievable, and hold your team accountable to. If you're the operator, holding your asset managers and your management team accountable. If you're a limited partner, I guess just checking in with your general partner and making sure that they're doing those things, and that you're getting those consistent updates, that they're focused on operations and not just the next deal. There's a lot of groups out there that I think got carried away and bought a lot of stuff, and I'm not going to name names. A lot of folks, or a few people in particular, have hit the headlines in the last month or two because some assets have been lost. But I think there was a lack of focus on operations. Everybody just got too carried away with buying.
Let's dive right into this pro forma budgeting and what that looks like. I feel like it's not talked about enough, and it's something that is crucially important, right?
Sure.
And so let's dive in there, but welcome back.
Appreciate it. Let's start from the top down, meaning starting with income, right? When you buy a property or invest in a property, it's hopefully occupied and generating some sort of income, starting with rents. So looking at the rents that are being achieved today and what some of the competing properties nearby are getting, right? And if they're getting higher rents, then you want to do some improvements ideally and strive for those higher rents. You're going to have vacancy loss. You're going to have loss to lease, which is the difference between what you call your market rent for each floor plan and what you actually contract that rent for each individual. So if market rent is $800 for one bedroom, but you run it out, or your management team rents it out for $750, you have a $50 loss to lease. That, assuming it's a 12-month lease, is going to carry for that 12-month period, or $600 total for the year. Then you have other income items. So you have application fees, late fees. You might be what we call rubbing back for utilities. Rub means ratio utility billing, and that's just where you're charging a portion of the utility expense back to the tenant. And typically your management team is hiring a third party to calculate that ratio based on square footage, number of occupants in the units, and sending that bill to the tenant. And then your management team is billing for the rent. So that's going to be your income side. And you, as if you're a limited partner, you're not going to determine those things, but it's going to be important that your general partner, whoever you're investing with, understands those things and is taking those steps, and you understand the management team that ultimately is going to be responsible for the day-to-day operations of that property. So going back to some things I mentioned on the last episode, if you fully vetted your general partner and your management team, presumably you've visited one or more properties that they already own and operate to see how those properties look and what the team is doing, so that you feel comfortable they're going to be able to do the same thing on any deal that you're investing in. If you see a lot of things that don't look good, that's going to raise some questions, and maybe some red flags to say, yeah, I don't know if this is the right partner for me to invest with. Going on to the expense side, right? So the management company is normally going to be or is going to be responsible for hiring and firing the what we call kind of in-house or management personnel, right, who are in the office, and then the folks who are out in the field, your maintenance personnel. So a rough rule of thumb, one in and one out for every 100 units. If you and you can of course have one in and one out for less than 100 units, but if you have more than 100 units, it's going to be pretty difficult for one manager and one maintenance guy to operate that many units by themselves. So that's kind of a general rule of thumb. So making sure that the payroll is being budgeted properly and the management team, of course, if they are managing thousands of units, they're going to have a process in place for hiring and firing folks and holding them accountable. But looking at the budgets and what I like to do as a broker, I've underwritten thousands of deals. So I typically know the management companies and how they've operated because we've underwritten a lot of deals where they've been the management company for a number of operators. So I have a pretty good sense for this property in this area that these management companies, based off historical performance, are going to do a good job. But a pro forma, which is a projection on what the income and expenses are going to be, is of course, right? You need that for your asset, but the historical performance, not only at that asset, if it's the same management company, I think that can be very helpful. If it's another management company, less so, but certain things like utility expenses are not going to change a whole lot unless you're going in and signing a new contract or implementing a water conservation effort, for example. And we can talk more about that. But looking at maybe a profit and loss statement for a similar size property or similar vintage property in the same area that management company is already operating, right? And just asking for the trailing 12-month P&L. A lot of times that information is going to want to be held confidential. They can black out the name of the property, but just seeing how historically they have a 100-unit property 2 miles away, what their repairs and maintenance and personnel and everything else have run at, to make sure that that aligns with the pro forma that they're putting in front of you or your operating partner. So you got all these high level repairs and maintenance, which is just your supplies. And if you're contracting out different things like make readies, et cetera, that's going to be one line item. You've got contract services, which to us is when we underwrite, that's going to be landscaping, pest control, and security that fall under contract services. A lot of lenders will also plug trash in that same line item. We separate trash as a separate line item and kind of treat it more like a utility. You've got administrative expenses, so supplies in the office, software, subscriptions, computers, etc. So looking at that, and that's normally going to be on the lower end. Payroll is going to be one of your bigger expenses. So going back on what I just touched on as far as how many people they have in the office, how many people they have out in the field working on units and repairs. Insurance, big item today. So normally your operating partner is going to have an insurance broker that they work with that's going to go out to the different carriers and shop them and get some quotes, but just kind of making sure that the insurance is being modeled appropriately on a pro forma basis. Because what I just mentioned on historical numbers, forget about insurance and taxes. Those, whatever happened in the past really doesn't matter. It's what is your new premium going to be? So getting updated quotes on insurance and then projections on the real estate taxes is very important because those are non-controllable items. Everything else that I kind of mentioned before, for the most part, the management company is going to be in charge of and be able to kind of control those expenses. And then you've got management fee. So your operating partner is going to negotiate what that fee is going to be, a percentage of the effective gross revenue. So bigger properties, 200 plus units, are going to have a lower percentage fee, but the whole dollars, of course, are going to be higher. And then a smaller property, assuming it has on-site staff, you might see as high as like a 5% of EGR management fee. And then you've got replacement reserves, which are what we call below the line, but all the permanent lenders, so Fannie Mae, Freddie Mac, CMBS loans, HUD, are going to require replacement reserves to be escrowed, and those can only be used and reimbursed for capital items such as replacing roofs or mechanical systems or plumbing or making upgrades to interiors or adding or upgrading amenities. So they can't be used for just normal kind of repair work that's done. So looking at all those different line items and the utilities, I kind of skipped over those, but electric, gas, and water are going to be your main utilities. So having an energy broker that you can work with on the electric and gas side of things that can kind of look at if you're able to secure a new contract, seeing kind of what those options are and if you're going to fix that for 1 year, 3 years, 5 years, whatever it may be on an energy contract, and then looking at gas. A lot of times you can't really negotiate the gas. It's going to be what it's going to be. And then the water sewer, you want to kind of look at what the consumption has been and if there's any way to reduce that consumption by inserting low flow toilets or shower heads or aerators and having your maintenance team or a third party go in and fix leaks that they find along the way. So that can be some significant cost savings that we've seen, especially here in Texas, where water sewer costs can get extraordinarily high in some municipalities. So yeah, those are all the items that you kind of have to focus on or make sure that your general partner is focusing on. And once again, depending on the market, we're advisors. So a lot of times folks that are new to the market and don't already have a management team in-house or in place will ask us to make some introductions. So we normally like to make a few introductions. And a lot of times certain people are going to gel with one company more than others, right? And so we'll give you a few options and make some introductions and recommend you go meet with them and do all those steps that I mentioned, right? Visit a property, ask to see their profit and loss statement to see who you think you're going to be able to work best with.
Yeah, no, that's a great just breakdown right there. So anybody that's not extremely familiar when it comes to thinking through a pro forma and what your operator should be thinking about, or as the operator, maybe you haven't seen too many of these or haven't dove in yet. It's a great breakdown right there, and you appreciate the detail. Of course, I'd love to know. Obviously, you've been through the transaction process of lots of properties, right? And specifically in multifamily, where have you seen the mistakes made, right? When thinking through this pro forma, when operators are buying something, right? And they're trying to create this pro forma, they're working with their management company. Where were the mistakes made? Or 6 months in, right? They figure out, oh, wait a minute, we didn't project this correctly, or we didn't know about this thing, or where have you seen that happen?
Yeah, I mean, look, a pro forma, one thing that I can safely say is everybody's pro forma is probably going to be wrong. So,
Yeah.
and I don't necessarily call it a mistake, but you want to learn from the differences, right? And what you projected and what actually happened. Where I've seen mistakes made are on the execution and timing of, the value add, if you will. And especially the last couple of years, we've had a lot of supply chain issues. So parts weren't delivered on time. So you've got units that are sitting idle and vacant for longer than projected. So the income in the first year or 2 years comes in less than what your management team or general partner projected. And some of the costs, right, went up, right? Because there was a lot more demand than there was supply, especially with the supply chain issues. On the construction side, we saw a lot of deals that were kind of under budgeted on that end. So you've got kind of the renovation or CapEx budget mistakes. Operationally, there's things that we just can't control. But a lot of times I've seen folks that will model real estate taxes and insurance growing at 3% a year, right? Like all the other expenses. Well, we've had inflation, so a lot of costs have gone up. And so that's made a lot of the other expenses go up more than 3%. But then real estate taxes and insurance in general, in particular, I should say, have gone way up. 5 years ago in Dallas, I would say on average, we were underwriting insurance at 450 to 500 a unit. And now it's going to be 800 to 1,000 a unit because the replacement cost has gone up. So what the amount of dollars that are being insured on every property has gone up significantly, and then the rates have gone up as well. So if you were only modeling, you bought your property 5 years ago and you were only modeling a 3% compounding increase, that would probably be about a 20% increase. You would expect insurance to be at 550 to 600 a unit. Well, it's 50% higher than that, right? So that's a mistake, or something where I think most groups weren't conservative enough. Similarly, on the real estate tax side of things, really having a good tax consultant that's going to advise you, and of course, use their historical and practical experience to help guide you on what your first year of taxes, which is normally your first or second year, depending on when you bought the property, is going to be your biggest jump in assessed value. Because at least in Texas, right, a lot of these counties or appraisal districts are tracking sales. So when they see something trade hands, they're going to get more aggressive on that reassessment. And then after that, it's ideally not as heavy of a jump, but a 3% tax growth probably isn't enough. It's, historically speaking, at least what I've seen, is probably going to be more like 5 to 15% a year, depending on the county and where your assessed value is when you bought it, right? So there's a lot of variables that you have to take into account. I've seen mistakes made on that. And the last thing would be payroll. And once again, some of these things we couldn't control, but with COVID and all the inflation and the labor shortage that was incurred, wages have gone up quite a bit. So if you were only modeling payroll to go up 3% a year, and that went up 15 or 20% to try to retain folks or hire new folks that have experience, then I've seen a lot of people be pretty under budgeted or under budget on payroll. That's another one that I would say has probably gone up in the last, I don't know, 10 years. It's gone up about 50% over the last 10 years, but a lot of that has been in the last 3 to 5 years.
Yeah, for sure. What about, and I don't know, some of these questions, it's hard to generalize, right? Because it could be so different per market and per operator and all these different variables. But just your thoughts on creating a successful performa with, say, in-house management versus third party. Just as you've worked with different groups, or your thoughts on that?
Yeah, I mean, I think it really depends on scale. A
Sure.
lot of groups that I've talked with aren't aren't going to bring management in-house until they've reached 2 or 3,000 units or more, because it's a lot of work. But then you do have your hands on the controls, and have a lot more just kind of control and knowledge on what's going on a day-to-day basis, because you've got people reporting to you. If the management is in-house, the advantages of going third party are you can kind of spread your wings a little bit more, right? And focus on the asset management side and kind of the bigger picture, and let the professional management experts kind of go do their job. Because a lot of times, until you reach that scale of multiple thousands of units, you might not have the depth of vendor connections, right? Where a plumber is going to give you preferred pricing compared to a big management company that they know they're going to get dozens or hundreds of jobs from, or have over the years, right? So there's a lot of pricing power for those larger management companies. So there's pros and cons to both. I think it just kind of depends on the size of your business and where you're geographically located, because you might own 3,000 units, but if they're not in the same geography, it doesn't really benefit you from a scale standpoint for management purposes. Then you're, in my mind, better off interviewing and hiring a larger management company that has the vendor resources and can handle the hiring and firing of the on-site personnel.
Yeah, that's helpful. Yeah, very helpful. I just appreciate your thoughts on the pro forma and even in-house versus third-party management. Some of that, I think that's I've heard that many times what you said, and so, or something similar. So appreciate your expertise, really, right? Your relationship with all these operators, and seeing who's doing what and what's most successful. Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.